Hello everyone, welcome again. In the last video we talked about uh, the normal distribution, and we talked a little bit about the mean and the volatility. So these are the three important things that we learned in the last video. The price of an underlying at expiration are normally distributed. The mean of the distribution is the forward price of the underlying contract, and the volatility is the standard deviation of the normal distribution. Again, an important thing to remember is that volatility, the volatility here is volatility, that's I mentioned, that's one standard deviation price change in percentage over 1 year. So this is for 1 year, and if you want to calculate it for daily volatility, so that would be this volatility figure, that is yearly divided by square root of number of working days. So there are roughly, so suppose if the volatility is 25% and there are approximately 256 working days in a year, that would be 25 by 16, that would be 1.56%. that would be the daily volatility. And same way, if you want to calculate weekly volatility, that would be the volatility divided by number of weeks, 52, that would be 7.2, and that would be 3.47%. So this is how you calculate daily and weekly volatilities. Now, I touched upon this in the last video that there are historical volatilities, and there is something known as implied volatility. So historical volatility, that is the movement of the underlying over a period of time in the past. So there are various websites that give this information about the underlying, and they express it as maybe 40-day moving average or a 30-day moving average. So this figure is easily available, that this is the historical data. But what we are looking for, and suppose if we have a crystal ball and if we look into the future, and if we can somehow find out what the future volatility is, we could be endlessly rich. We could make all the money in the world, and this is what we strive for, to calculate future volatilities. We make all the predictions, learn various tools, do all the analysis to understand what the future volatility is, and that's very difficult to predict. Also, again, one more term for historical volatility is, it's also known as realized volatility. That has been realized. An important thing to remember is that historical volatility, when we're talking about historical volatility, we are talking about the underlying. But when you're doing an option trading, you will frequently come across the term known as implied volatility. And this implied volatility, this is the volatility associated with an option. So how do we get to this figure of how do we get this implied volatility? So what we do is we check out what the price of an option is, and then we reverse engineer the theoretical pricing model to find out what the volatility should be to get that market price of an option. So if you remember in the Black-Scholes model, there was there was an there was a volatility input, and this, if you put this volatility input as per this assumption, whatever the assumption is, uh, you would get, say, the option value at $2. But then you go into the market and you want to trade this option, you find that it is selling for $3. So if you do a quick mental check, you will find that all other inputs in the theoretical pricing model are relatively unchanged. The time period is still the same, the price of the underlying is the same, and when you look at it, you can say, you can think that the only thing that could be different from my assumption than anybody who is selling this option at a higher price is the volatility input. So you plug in, you reverse engineer that, the Black-Scholes model, and you check for various volatilities that would give you this price. Remember, this is the theoretical price of the option, but it's actually trading at this price, and you plug in different volatility inputs till you get this price. So suppose the Black-Scholes model had the theoretical price had an assumption that the volatility is 25, but when you actually do the reverse calculation, you find that the market participants are using a volatility assumption of 40. So implied volatility is 40, and this is in fact what implied volatility is. It's the market opinion of what the volatility is about that particular underlying, and this is associated with an option. Now again, one of the things to remember is that when we are talking about the volatility, you might find various services giving the implied volatility, and I found that most confusing when I started doing this. Is they will give you a graph saying, hey, this is the implied volatility, and I would always confuse as to, there are various strike prices, and how does one give one graph, one line for all the implied volatilities associated with a particular option. And what happens is that this is different people use different criteria, and this is mostly the implied volatility. This is mostly a weighted average, and this could be that depending on the greatest weight of given to at the money options, then out of the money options, and this implied volatility curve is drawn using this weighted average. Now what we do is we try to compare the historical volatility with the implied volatility. We do not have, it is very difficult to predict the implied volatility, and you have to go through years of experience to do that. But historical volatility gives us a perspective of whether the implied volatility that the market participants are using, is their figure overestimated? Is it underestimated? Are they underestimating the volatility, or they overestimating the volatility? And we look at the historical volatility to get that feel. So if the implied volatility is in our understanding, the implied volatility is too high, the options are overpriced, we might not want to touch those. But if the implied volatility is low, we might want to buy that, or we might. So this is how we do. But again, there is not the strict correlation between implied volatility and historical volatility. Yeah, one might have to go through years of understanding, and we will talk more about implied volatility and the historical volatility going forward.